Why the stock market might be broken. The narrative of index funds and their phenomenal rise in popularity begins with a fundamental notion that has been persistently advocated over the course of several decades by financial counselors, educators, and individuals who are enthusiastic about investing. This concept has been promoted by persons who are passionate about investing. Many of us learn our first lessons about investing by putting our money into index funds. This is one of the first lessons that we learn. The lesson that you are about to learn is one of the most important ones. These funds, which are designed to mirror large chunks of the market, such as the S&P 500, have been steadily rising in popularity among both the general public and the professional investment community. These funds are designed to replicate the performance of major portions of the market. This strategy is, according to a number of people, the most straightforward way to create riches from a statistical point of view. The success of this investment technique for the average investor has been emphasized by a great number of industry experts. This has resulted in the accumulation of trillions of dollars in passive investment vehicles over the course of the years, which has contributed to index funds becoming an integral component of modern investing strategies. This is the effect that this has had. This achievement is built around the efficient market hypothesis, EMH, which is a hypothesis that has been around for decades and serves as the basis upon which this success is building. It was first proposed in the 1960s that stock prices always represent all of the information that is available, and therefore it is extremely difficult to consistently outperform the market. This notion was initially stated in the 1960s. One of the reasons that index funds are so appealing is that, according to this point of view, the most efficient way to invest is to simply follow the overall market. This is the reason why index funds are so appealing. In order to give investors with returns that are equivalent to the performance of the general market, these funds present the promise of a clear solution. Even while index funds have witnessed spectacular development, with an ever-increasing number of persons investing in them through brokerage platforms and retirement accounts, an increasing number of analysts are beginning to express their concerns. This is despite the fact that index funds have been subject to a growing number of investors. Index funds are responsible for driving up the values of shares to levels that cannot be maintained, which is one of the most major worries. Index funds are accountable for this. There is a growing concern among market participants that the market may be overpriced, which could lead to a significant fall within the market. This worry is reinforced by the fact that trillions of dollars are moving into instruments that are specifically designed for passive investment. There has been a movement in the performance of the market that has never been witnessed before, and that shift is the fact that the amount of money invested in index funds has now surpassed the amount of money placed into actively managed funds. A considerable number of these concerns are a direct outcome of the way in which the efficient market hypothesis, EMH, and index funds have altered our understanding of the forces that drive stock prices. This is the origin of a significant number of these fears. According to the efficient market hypothesis, EMH, stock prices are always accurate reflections of all the information that is available, and the selection of individual stocks has very little to no impact on the market as a whole. This is the premise that underpins the EMH. In light of this line of reasoning, index funds, which aim to imitate the performance of the market rather than surpass it, have gained a growing amount of popularity in recent years. In the event that the market is efficient, it would be more profitable for the average investor to do nothing more than watch the market through the use of an index fund. Because of this, the index fund would most likely provide returns that are equivalent to or even higher to those that would be generated by attempting to pick individual stocks or by utilizing active management strategies. This is due to the fact that the index fund would be actively managed. However, it is essential to keep in mind that not everyone is of the opinion that index funds are the most effective method for ensuring one's financial security. Some critics believe that there is a risk that the value of stocks will be distorted if more money is invested in passive funds, This is something that they believe will happen. The level of anxiety that is being expressed has increased as a result of the introduction of a new concept that is known as the inelastic market hypothesis, which was proposed by Xavier Buybacks and other economists. According to this concept, index funds have a significant degree of influence on the market because they invest vast sums of money in specific stocks, regardless of whether or not those stocks are costly. This is the case regardless of whether or not the stocks in question are overpriced. Buybacks and his colleagues argue that the value of the market as a whole can increase by as much as $5 for every dollar that is invested in the market. This is in opposition to the predictions that are made by the efficient market hypothesis, which can be seen in the previous sentence. In comparison to what the EMH forecasts, this multiplier is significantly higher. This, in turn, begs the question of whether the current surge in stock prices is genuinely sustainable, or whether the market is witnessing a bubble that is being fed by investors who are not actively making decisions, but rather by investors who are passively investing. The question that needs to be answered is whether or not the market is currently experiencing a bubble. We may notice an inflation of stock prices if index funds continue to pour money into the market without taking into account the values of individual stocks. This may eventually result in a large market correction in the event that investors begin selling off their holdings, which would be a consequence of the inflation of stock prices. Index funds have a devoted following of supporters, which includes those who work in the financial business. A great number of individuals find index funds to be an enticing option due to the fact that they are simple to use and inexpensive. This is especially true when it comes to the accumulation of wealth over a more extended period of time. In spite of the fact that there are individuals who are concerned that index funds are overvaluing equities, there are also individuals who are of the opinion that the sheer consistency of index funds, in addition to their cheap expenses, continue to make them a suitable alternative for the majority of investors. After everything is said and done, the debate over index funds centers on the question of whether or not the current market is actually efficient. The question of whether the creation of passive investment is a benefit or a probable concern for the market is still unsolved, and the answer to this question will only be disclosed by the passage of time. On the other hand, the existence of passive investment is a question that has not yet been addressed. Thanks for watching. Don't forget to like and subscribe to our YouTube channel.